Are we on?
It looks like we're live, my friend. Just
Fan?
waiting for it to feed on over to the other side here.
The other side of the moon?
My monitor, my personal monitor, which is my
Oh.
phone.
Oh, okay. Right on.
Good afternoon, Miguel.
Good afternoon, my brother, Jared.
How are you, my friend?
Doing extreme. Well, I think I'm doing a little too well. I feel like in an awesome mood. I'm ready to just tear things up.
All right. That's what happens when you have some rock stars. Huh?
Well, that's what it's made for, yeah.
To make you feel like a rock star.
There you go. Yeah, I like it. Yeah.
Dig it, man. Dig it. Dig it.
Yeah.
So we are back on the live mode, 2 p.m. on Tuesday.
Mm-hmm.
We got a nice little setup here in my office, and our goal here is to make sure that we are bringing the right information the first time in real time. How about that one, huh?
I like that. I like that.
In real time. So this is Real Estate and the Economy this week. My name is Jared Uraine with the Five Diamond Group here at Vice Realty, and Miguel Francis, or Michael Anthony Francis, known as
The Blind Economist.
Blind Economist. Now,
Yeah.
you want to shout out your, I'm going to adjust the microphone just so you
Oh.
know, so that's good. We get closer
Right.
to you. Go ahead and shout out your handle and all of your,
What I do?
yeah.
Well, I'm the Blind Economist, and some people think that's a catchy name. They think it's possibly because I'm blind to particular agendas and stuff like that.
What was that word that you used earlier? The opportunity that's...
Oh, yeah, we'll get to that. Arbitrage.
Arbitrage,
Yeah, it's a
yes.
great one, yeah. But, yeah, they kind of wonder, why I choose. Well, because I'm blind, meaning I cannot see, which is fine. I have 3 episodes that come out. On Monday, we do personal finance, where you could learn how to make a strategic budget, how to manage your credit card debt, your FICO scores. On Thursdays, we produce an episode. It's called Money Matters by the Blind Economist, and it's basically talking about the economic calendar and what's happening in the economy domestically in the United States, and at times around different parts of the world. And then we have Global Insights on Sunday, where we interview people from around the globe, getting their understanding of what's happening in their market, how it impacts their industry, and what they see as the road ahead.
Getting the outside perspective.
Mhm.
I love that.
But we're making a change to 2 of the episodes. The personal finance and money matters. And personal finance is going to involve you.
Yes.
Yeah, yeah. We're going to mix it up a little bit. I'm going to have a co-host, and you'll be there, and we're going to do it together.
So we're going
Yeah.
to break down the best practices and ways to improve personal finance to get prepared and adjusted in today's economy.
And that personal finance episode can be applied to a household or even a small business, So the principles apply across the board,
Yes,
yeah.
they do.
So you and I are going to be doing that together. So I'm looking forward to that.
Me too. Me too.
Yeah.
So if you want to stay updated with the latest news, behind-the-scenes footage, or exclusive content that both Michael, myself, or Isaac on my team, or anyone else on the Five Diamond Group or in the Blind Economist world, make sure you save the reminders as well as subscribe to any of the new episodes that come across. So you can hit that reminder button, save it as a notice, and of course, if you do like the content, we'd be honored if you'd share that with others that could benefit from it.
Absolutely.
Miguel, we were talking yesterday on the Move It podcast about the median price point nationally is at $426.
Wow.
Which is the second time it's been the highest median sales price for residential homes in history. We here in Las Vegas are at $442,900 as far as our median price point. And so the question holds for us is we have limited inventory. We see rates kind of staying around the sevens. We had the core report come out last week, and the question is, are we going to stay around 7% on the mortgage rate, or are we going to hopefully see lower rates coming up? What would be your take on those?
Well, mortgage rates. Well, I want to just mention something about inventory. That number's coming out later this week. Available homes on the market. Last reported, I think it was 4.6 billion. 4.6 million, which is a tight inventory. and it's projected to go down. And so I wouldn't be surprised if we see a continued upward pressure on real estate because of the lack of inventory. And I think you told me that in the Las Vegas market, there's only 1.6 month supply,
Correct.
which is sort of
For single-family homes, correct.
sort of insane. So mortgage rates, are they going up or down? Well, you knew I was a baker when I was a kid, right? Did
Right.
I
As a kid, okay.
Well, you know,
Well, when you say a kid, I was thinking of like 10 years
7,
old.
yeah,
But,
yeah,
but
yeah,
you meant a few
yeah,
years
yeah,
ago.
yeah,
Right.
yeah. I was either 19 or 20. I was a pastry chef at Caesar's Palace, you know, and so I like baking metaphors. And so, what I want to talk about today is how inflation, decisions by the Federal Reserve, and the very interesting one, how the short-term duration of 30-year fixed mortgages, how those three things impact mortgage rates. And you can compare it to baking, right? So think of the inflation as the mixing powder for this magical cake that grows money trees, right? Right. And then the Federal Reserve, that's the heat of the oven. It either heats things up or cools things down. And the shorter term 30-year mortgages,
Okay.
that's like the icing on the cake that either makes it sweet or sour, depending. But not to worry, if you have a good baker and they have the right recipe, it'll all work out.
Yeah.
Yeah. So we take this in three parts.
Got it. And so, in reference to mortgage rates, or really kind of the Fed rate, because that's based off of what the Fed will do.
That's part of it, yeah.
We know that there's been kind of a positive reaction to the core numbers that came out last week, because it came in better than expected. Even though everybody hears the headline of 3%, the real core numbers are at 4.8.
That's correct. Down from 5.3. That's a huge drop. And I'm super impressed that you're talking about core CPI, Consumer Price Index.
I better after 10 episodes.
Yeah.
Or however many we've
Yeah, yeah, yeah. Because that's what matters to the Federal Reserve. Now, just to say it again, core CPI, Consumer Price Index rates, we're talking about inflation. And when they say core CPI, they're removing food and energy because those numbers are too volatile for the Fed to make policy decisions. So they focus on core consumer price index and they focus on core PCE, personal expense consumption. Those core numbers are a big part of how the Fed makes decisions. And yeah, whatever the Fed decides to do as far as their policy goes, whether they're going to continue to raise the rate, has an impact on mortgages. And because inflation was down last week, as you said, unfortunately, the whole world's focused on the 3% headline number. I guess that's good for consumer sentiment. That does create a problem, though. When everybody thinks, oh, good, inflation's down to 3%, that makes them more comfortable with the current inflation we're facing, which in the real world is 4.8. But anyway, because the numbers did come in better last week, there's a lot of positive sentiment, both by the market and consumers, that the Fed is getting ready to stop its aggressive rate hikes. Now, it's going back to our baking illustration, it's already baked in that they're going to raise the rate in July. And I believe they're going to raise it again in September. Now, I previously have said that I thought they would raise it in November, but now that the economy is in fact slowing down a little bit, July and September, it's quite probable that they're going to pause and wait and see what happens after that. But that's that's one of the three ingredients that we're discussing today that impacts mortgage rates is the Fed's decision. So because the Fed is going to go up at least twice more this year, probably not more than that, that is going to have an upward pressure on mortgage rates. We were looking at it earlier. What did Freddie Mac report last Thursday? Was it?
As of last Thursday,
Yeah.
the 30-year fixed mortgage rate off of Freddie Mac was 6.96% as of July 13th.
And I like Freddie Mac. It's a government report, and they're not agenda driven. Other reports or surveys you see may or may not include APR. If you want a consistent number, Freddie Mac's the one to look at. However, what'd you say, 6.96?
Correct.
Yeah, that's up there. You know, that's up there. I think rates are higher right now since they've been since October of 2022. So that's a bit of a push. Um, Another item though that affects has a upward pressure on mortgages is inflation.
Mm-hmm.
As long as inflation is high, now this is separate from Federal Reserve policy decisions. When inflation is high, and again, as you so accurately and eloquently and intelligently said, core inflation, core CPI, core PCE, it's a 4.8. You know, that's more than double the Fed's target rate. By the way, the Fed doesn't anticipate meeting its target until 2026.
That's a big point to make because a lot of the market and the headline news that we're hearing is that things are going to get quote unquote back to normal later this year, maybe early next year. And that's a big gap, a big stretch from the reality of what the Fed's going to do.
Right. Back to normal. That's a funny expression, you know, because normal's kind of something that's not a part of our lives anymore. You know, we've talked in the past about disruptions. Um, in the war in Ukraine, I think it was yesterday or today, Russia broke its agreement about allowing food to come out of Ukraine, and they bombed a port.
Right.
Yeah, so that would be a market disruption, you know. But when inflation is high, which 4.8 came down, that's great, but that's still high. So that forces mortgage lenders to have a wider spread between the 10-year Treasury and the mortgage rates, because if core inflation is high, then those lenders have to pay for those additional expenses, you know. It's still a real world cost. And if lenders are going to stay in business, they have to cover their costs just like everybody else. You know.
So as of today, the spread is 3.9%, 3.09 points.
Between the 10-year Treasury?
Yeah, with 10-year yield at 3.57 and 30-year mortgage at 6.6.
Okay.
So if the spread was normalized, rates should be between 5 and 7, 5.57, somewhere between 5 and 5.57.
Right. Well, yeah, and there's a lot of people talking about that, but and that's sort of the third leg to our recipe is well, not quite yet. That's part of it though. The spread between the 10-year Treasury and the 30-year mortgage, fixed mortgage rate is wide right now, a little over 3%. Historically, it should be 1.7. So you said correctly that if we had a normal spread between the 10-year Treasury and the 30-year fixed, it would be in the neighborhood of 1.7, right, in that neighborhood. The reason it is not is because the only time the spread is normal is when the market is normal. If there's market disruptions, market uncertainty, such as inflation, such as a war in Ukraine, those things force lenders to increase the spread to cover that risk. It's a business decision. If they don't do it, they'll go the way of Countrywide, of Washington Mutual, and other banks. Bear Stearns, they'll be gone. They'll be gone. And First Republic, one of our favorites, right? So they have to have the reason the spread is so much. The banks are not being greedy; they're surviving. That's what they have to do. And the reason that spread is so high, again, is because of all the market uncertainty with inflation, and there's an additional piece to it. because the sentiment, both of the market and of the mortgage industry, and of realtors and of consumers, everybody thinks inaccurately. Wow, that sounds haughty. But anyway, everybody thinks inaccurately that rates are going to come down this year. Uh, I don't know. Are these people using an abacus? I don't know how they come to that. There's no way they're going to come down this year. But anyway, because they think rates are going to come down, here's the spot the mortgage companies are in. The mortgage companies then are anticipating that anybody who gets a 30-year fixed rate today, by the end of the year, is going to refinance because rates are going to be more attractive, right? So what that means is that they're going to make less interest because it is a shorter term of a long term of a 30-year fixed. When when lenders issue a loan, they package it with a few hundred loans, and it's supposed to have a certain yield or return, and it's sold on Wall Street as a CMO, certified mortgage obligation. Well, if that package, let's say there's 250 loans in that certified mortgage obligation security now that's being sold on Wall Street, if some of those loans refinance and they're no longer a part of that package, that CMO is not going to return what the market anticipated. Those guys on Wall Street are pretty smart. They know that, so they're not going to pay as much for that security instrument. In order to offset that, that forces lenders to keep the rates high.
Yeah, yeah.
It's like clear as mud, right?
Yeah, no, it makes a lot of sense. So, bottom line is, while everybody thinks that rates are going to be coming down, projections want to say rates will come down, especially with the way inflation is moving. The truth is that it doesn't make financial sense for mortgage lenders to offer lower rates later this year because they're basically shooting themselves in the foot.
Right.
And at the end of the day, why would they offer a loan now and then offer a lower rate later? Because then that would spur on a refinance boom, which would then eliminate or nullify all of the loan packages, CMOs, that are currently being traded on Wall Street. Now, they have a certain performance level that needs to hit, a target that it has to perform over a certain period of time that they expect.
Right.
And so that kind of puts into context why it makes sense that we're going to be staying around our current rate of around 7%, and
through the end of the
through
year.
the end of the year,
Right.
definitely, and we're looking at least another couple of years before any sort of softening happens.
Well, there's a potential for softening if if hypothetically we continue to see core inflation numbers come down, right? And if the Fed does pause after a couple of more hikes, then there could be, as the inflation rates come down, the spread between the 10-year Treasury and the 30-year fixed can then be reduced. And the 10-year Treasury is likely to come down when that happens. So the 10-year Treasury will dip below 4%, and maybe instead of having a 3% spread, then it might drop to a 2.2%, 2.5% spread. You know, that could bring us down to 6.5 for a 30-year fixed. And I can see that happening in Q2, the second quarter of 2024. And hopefully by the end of 2024, if there's no more market disruptions, which have been a regular part of our lives, we could be in the neighborhood of 6% by the end of 2024. There's some people that I read about this morning. They're anticipating 5.5 by Q1 of next year, or even the end of this year.
Right.
Impossible. It's not going to happen. And so I see 5.5 at some point in 2025, maybe, you know.
So
but
I at this moment, I just want to put a pause on this. This would be a good moment to do a real introduction with the shorts, like on YouTube, you know, the shorts, video shorts on YouTube.
Yeah.
Yeah. So this would be something like, are you waiting for 5% mortgages next year? Stay tuned. The Blind Economist will answer shortly. something along those lines. Sorry.
Oh,
Just had to throw that in.
it's
Now that we can take it back and
do you want me to do it?
go for it.
Yeah, 5.5%, as many are anticipating at the end of 2023, is not realistic. If you believe that, then I have some magic beans for you. They'll grow a beanstalk.
Really?
Yeah, yeah, absolutely. Yeah,
Do they grow trees up into the heavens?
yeah, into the heavens, right? Yeah, there's a castle at the top. Yeah, but yeah, to understand the dynamics between inflation, the Federal Reserve, the shorter duration of the life of a 30-year fixed, and the mortgage demand, all of those compensating factors will prevent us from seeing 5.5% until sometime in hopefully early 2025, not any time before then.
Yeah.
Yeah, we're looking at the high sixes, near and around 7 through the rest of this year.
Thank you. So, what would be some of the action items if someone is thinking about buying or selling in this market, or really just at the current moment? What are the current action items someone should be looking out for?
Well, it depends on, as every individual's a snowflake, not meaning that they're flaky, but everybody's situation is unique. And so if they're able to make the move and sell their property and move into what they like, do not wait for the desired mortgage rate. That'll cost you money in the long run. You can always refinance later when and if those rates come down. If you're able to make the move, make the move.
Right.
Make it now. If you're not able to make the move, that is okay. That gives you an opportunity to improve your credit profile.
Right.
Work on your FICO score, your credit scores. And if you want to learn more how to do that, then watch Personal Finance on the Blind Economist. And work on your FICO scores, your credit worthiness. And it also gives you an opportunity to put cash aside for a down payment. And if you are looking at selling your home, do we dare touch this conversation about how to prepare? Yeah.
Well,
Yeah.
getting the home on the market is a super big. Let me try that again. Is a wonderful opportunity because of the limited inventory, right? So
Right.
that means that most homes will have a nice spotlight, depending on where it sits in the price point of the spectrum of pricing. You will more than likely get multiple offers, especially if it's not only priced right but marketed even
Right.
better.
But if you aren't prepared to make the move right now, that does give you an opportunity to prepare your home to make it as attractive as possible on the market.
Yeah.
Here's the caveat and here's the catch. Be careful what you spend your money on. Spend your money on the front yard. That's the only place you're going to get dollar for dollar return. If you want to do internal work, you can replace fixtures, door handles. You might want to paint the walls. At the most, if it needs to be done, replace the carpet. But don't buy a plush carpet. Just get FHA grade carpet that looks good. Well, depending on the type of home. But don't go through a lot of remodeling with new cabinets and new counters, because you'll only get pennies on the dollar when it's time to sell. So the way to think about it is this. If all the comparable homes in your neighborhood that are basically a near model match, and those homes, if they're slightly nicer than yours, instead of spending money to remodel, simply price it correctly. Everybody says there's 3 things that matter about real estate. They say it's location, location, location. I'll tell you what, that's wrong. That's wrong. What matters about real estate is price, price, price. You need to price the property correctly if you want it to move.
Yeah, and the challenge we face frequently is many homeowners will say, well, hey, that's a model match unit. My home should be XYZ. And you nail it right on the head in terms of getting the price right, because a buyer will probably see the value in a home that's fully remodeled and will be willing to pay a higher price for something like that. But that doesn't mean you as a seller need to go and remodel your entire house, because
Right.
you want to try and get that price. Like you
Right.
said, you're not going to get the dollar for dollar return
Right.
just to be able to get that. Why would you go and spend the money and time and effort just to get that done? It
Right.
doesn't make any sense. So if you're pricing it right, you should be able to get close to it.
Mm.
But a lot of times it is a change in understanding and market performances that we need to help our clients get to, and that's why we're here.
Well, and we have to keep in mind, what is the goal when you sell the property?
Yeah.
Is your goal to get the highest price possible or to walk away with as much as money as possible?
Right?
It's to
As
walk
quickly as possible right now.
as quickly. The goal is to walk away with as much money.
Mhm.
All of this sounds a little bit complicated, and guess what? It is. That's why you need a professional.
Mhm.
You need somebody like, I hate to plug your thing because I'm on your channel, but the Five Diamond Group. I'm very opinionated when it comes to realtors, and you guys do a good job. And I do not say that easily, I don't say that. And you guys got a good team with your.
I just pressed send on the Venmo payment, by the way. So
You just what?
pressed send on the Venmo payment. Just kidding.
Okay, good. Yeah. Well, I'll tell you what I need. I want one of these mics for the Blind Economist. But anyway, yeah, no, seriously, you guys do a good job. You have a good team with Dilcia. She follows and makes sure that the transactions are cared for, get closed. You deal with good title and escrow people. You have a strong mortgage team. You have the entire ecosystem and professionalism that people need. And if I understand correctly, let me think. Your 2023 goals. Are you going to make them this year?
I think we're going to stretch our goals.
Because what happened?
Yeah, well,
Go ahead. You can say it.
well, we've certainly reached milestones that we were targeting for the year. We didn't anticipate to hit, so now we're
To
on our
be
stretch
clear,
goals.
you hit your
Yeah,
2023 goals already. Am I right?
true.
There you go. Yeah, you need somebody who's doing that. If you're going to do, the way to think about it is, let's say that you have illness and you don't know what's going on. Are you going to go to your cousin who watches a lot of YouTube on natural remedies, or are you going to go to a professional physician,
Hmm.
right? You need to go to a professional if you want to get it done correctly. So, I hate to sound like a commercial,
Well,
but the Five Diamond Group does a good job.
the goal with these podcasts and with our endeavor to share this information, especially with the economy,
Yeah.
it's boring, it's dry, but you know what? You need someone who's in there, local, who understands what's going on, and so that's part
Right.
of the reason why we connect with you, because you've got the history, you've got the connections and the relationship, but most importantly, you're able to break it down so that we can process it. And so, getting the right information the first time for our clients, super important.
Yeah.
And that only happens when we educate ourselves and we're willing to
Right.
make that education. So whether it's business, whether it's life, or in this case, the economy, which has been something I've been wanting to learn for a long time.
Right.
I'm grateful to you, man, because
Oh,
thank you so
well.
much for being here and helping us out. So.
Yeah. Well, we still have to talk about arbitrage someday.
See, I think the arbitrage in this scenario is you.
Oh,
Being able to recognize the opportunity that's here, especially pumping out information in a digital world that we have.
Right.
And the cool thing is you quote unquote see the opportunity in the Blind Economist.
ah,
How about
yeah.
that tagline?
Yeah,
huh?
I like it. That's pretty good. I like it. Yeah.
See the opportunity with the
Yeah,
Blind
yeah.
Economist. There you go.
I
There's your
like
hook.
it. That is pretty good. I kind of like it. Yeah, yeah.
Well, anything else, Mike, before we wrap it up?
Well, yeah, keep an eye on inventory levels. It's coming out on Thursday. As far as real estate goes, it's anticipated to go down. That means there's going to be fewer homes on the market to pick from. And again, that's going to have an upward pressure on real estate prices. And also, new unemployment claims are expected to go up slightly on Thursday. We'll have to wait and see. Overall, the general hope is that the efforts of the Federal Reserve by raising the interest rates are going to cool the economy a little bit. And as that happens, that hopefully will allow mortgage rates to come into a more reasonable level for those who can barely get into a home right now.
Interesting.
Yeah.
Interesting opportunity.
Yeah.
Well, we'd love to get your feedback. If you are interested in understanding anything else on these subjects regarding the economy or real estate, I would love to be able to hear your comments. You can drop them into the comments box or a direct message either one of us on our channels. Also, you can reach the Blind Economist on LinkedIn as well as YouTube at the Blind Economist, right?
Right. You can go to Google, type in the Blind Economist. I'm
You'll
the
find 'em.
number one and number
That's
two
right.
result.
Top ranking. And of course,
Yeah.
the Five Diamond Group at Five Diamond Group on any of the social media outlets. Miguel, Mike, thank you so much for hanging out, man.
Thank
you
you,
for the
bro.
insights. Look forward to seeing you next Tuesday at 2 o'clock. Same bat channel, same bat place.
Sounds
as
good.
they used to say, right?
That's right. Yeah.
And that does it for this episode, episode 10 of Real Estate and the Economy this week. My name is Jared Uraine with the Five Diamond Group here at Vice Realty and the Blind Economist Miguel A. Francis. My man, enjoy your week,
Thank you, bro.
and we'll talk to you next week.
See you then.